Welcome, everyone. We're just waiting a couple of seconds for people to join in, and then we'll get started. Good morning, everyone. If you'd like to, you're welcome to put your name and the company you work for in the chat, so we get a bit of a feeling for who's there as we wait for more to arrive. Great. Okay. Now we'll get started. Welcome everyone to this webinar on climate risk. I'm very happy to have everybody here. Thanks for taking your Wednesday morning time to be with us today and discussing climate risks. I'll do a bit more of an introduction in a second, but climate risk is one of those topics that I find really interesting right now, with a lot of things happening. Of course, also with the increasing kind of focus on the financial implications of sustainability and climate risk. That gives me a lot of hope and a glimpse into the kinds of things that are already changing and where we get to be having better discussions with the core business of companies on the type of change that's coming and the kinds of transitions that the companies should be doing. So I'm really excited to touch on a bit of that today. And we'll start with a little bit of an introduction also on some of the more administrative aspects, and then we'll go into the content. I already mentioned, and I think many of you are doing this, do please add your name and the company you work for, or the country you are in the chat, so everybody gets a bit of an overview of who is on the call. We are a couple of admin things. We are recording the session, and as always, we'll put it onto our YouTube channel. So we'll send the link out after the webinar, so you don't need to take all the screenshots of every slide. You'll just get that in your inbox afterwards. Of course, feel free to do it regardless if you'd like to do. We also have, as always we do in our webinars, a good amount of time allocated for Q&A. To discuss some of the questions that you might have about climate risk, about how to apply it, about how to make the case about value from climate risk. So please do use the Q&A function. You're welcome, of course, also to just add your questions in the chat. But the Q&A function really allows us to filter through the questions and cluster them a bit better. So please feel free to use that. Sometimes we can also then answer some of the questions already as we go through the presentations. In terms of us, who we are here today, my name is Sven Beiersdorf. I'm co-founder of Nordic Sustainability, and I'll be giving us a bit of the introduction here. And I'm lucky to have with me Tilly, who is our senior manager and climate risk lead, coming with a background from the financial sector side, where, of course, a lot of the climate risk related debates have been maturing earlier than they have in the rest of the corporate field. And then we also are lucky to have with us Freddie, who comes with a lot of experience from climate risk projects, also having built some of his own models around it. And Freddie will take us through the ins and outs of how to do a climate risk assessment, and Tilly will talk more about the question of how to integrate the results and go from risk to value. And that also is reflected in our agenda. We'll start with, after these opening remarks, with a smaller part around the smallest intro around some of the misconceptions we see about climate risk, some of the misunderstandings that we should all be aware of. Then we'll go, Freddie will guide us through how to conduct a climate risk assessment. And then lastly, we go to the question of how to move from risk to value. And then afterwards, we have about 15 minutes to do a Q&A. Just before we start, for those of you who might not know us, a couple of words about us at Nordic Sustainability. We're around 40 sustainability consultants and specialists located here in Denmark. We work across the range of sustainability-related topics to offer kind of full suite of services to our clients. We work within three main pillars, and a cross-cutting investment stream. So we work with strategy projects, ESG strategy, sustainability strategy, value creation analyses, value risk analyses in our strategy team. We have a reporting policy team that's working with all the incoming regulation that is still, of course, very much in the pipeline despite the omnibus uncertainties. We also have a large climate and nature team where this work is anchored around the climate risk, but also the climate transition plan work that we do with many of our clients right now, but also nature biodiversity assessments that we do for our clients. And then we have a cross-cutting pillar of investments and ownership where we work with different private equity organizations or financial sector organizations on sustainability. We're lucky to be working with many of the leading companies, both here in Denmark and abroad. We have a portfolio of clients across Europe, so we're very used to working across borders and with many of the large organizations. And we likewise work across sectors, though many of the sectors we work with have very physical products or large physical installations, if it's manufacturing, machinery and tech, energy sector, but also textiles, medtech, and pharma. So we work across many of these types of sectors. That enough about us, and then we can just dive into the topic. So just 3 high-level points with a little bit of underlying information of why we think climate risk is so inherently misunderstood and still undervalued in many ways. It is, of course, a still relatively new area that is maturing, but still we feel like it hasn't quite hit its moment in the prime light yet as it should do. So 3 of those misconceptions. The first one is that we're talking about something that's very much already here. It's not in the distant future, right? And I think climate risk always has that thing about being something that happens when climate disruption really happens, but a lot of the effects we already see. Secondly, climate risk is very much something that's integral to the business. It's not something that should be managed at the periphery. Definitely not something that should be managed in the silo of the sustainability organization alone. And the third one is, and I think this is one of the most realized parts of our climate risk, is that it's crucial for investment decisions and especially also the current wave of discussions around sustainability ROI. So going into each of these with a little bit more detail. First one, we are very much seeing that in many ways companies are already being affected by climate change and by climate risk. One of the easiest cases to make this argument is, of course, commodity prices. We see, because of changing weather conditions in different locations, commodity prices for certain key commodities are already changing. Here, just 2 statistics. One is on the global cocoa production, where we saw that in 2024, or the drought that led up to February 2024, created a 300% price increase year on year on the production coming out of Ghana and Ivory Coast, who are responsible for most of 60% of the world's cocoa production. Similarly, Spain is responsible for bringing about 40% of the global olive oil to the market. And there, because of the drought in 2022 and 23, we saw about a 50% increase in olive oil prices. And of course, this is commodities right now, but there's no reason why this shouldn't similarly start happening about other other materials, critical raw materials, of course, with the increasing demand we have on them, but also potential increasing disruption, geopolitical or conflict issues. So we very much see that for many companies, the bedrock of their operations is already being affected here. Of course, tariffs being another impact factor here. What is also really interesting to us is that this is very much something that both the insurers and the finance sector are waking up to. I think many of you might have seen reports about insurers, especially in the US, simply not insuring certain locations anymore. I think there's been a lot of coverage on houses on the Florida coast and not being insurable anymore. a lot of people in around Los Angeles saw their insurance policies being canceled right before the LA wildfires in February 2025. And for us, these are just the earliest signs of what's happening to the kind of global insurance and financial sector integration. There are statistics that something like the amounts or the losses due to natural catastrophes are amounting to something around $100 billion annually across the 2020 to 2023 period. And of course, that is something that is getting increasing attention. So we see many more insurers integrating climate risk into their underwriting, into their risk models. And we see the same for financial institutions. I think the most recent was a few weeks ago when the ECB came out announcing that they will integrate climate factor into their collateral framework. So we see this trickling down right now into the kind of into the strategy of these larger financial institutions, and we expect this within a year or two to be much more present in investor relation conversations that your IR departments will also be having with those financial institutions. To the second point, that is core of the business, right? I think the rising commodity prices argument makes that already clear, but I think climate risk has often been treated as something that's manageable on the outside. And I think that comes a lot from the fact that if the initial TCFD analysis that many companies did was something where people got into a room, they sat together for half a day, thinking about what are climate risks, looked at some high level, physical risk models, did their first risk analysis for the company, put in the annual report, and then repeated it from there, repeated the similar disclosure year on year, right? But what's happened since is that we have a lot more knowledge around the risk types, around the science and underlying data behind these types of analyses. So while it's still a frontier concept, we have a lot better methods now to understand and analyze climate risks, and a lot more awareness, of course, not just on the physical risks, but also on the transition risks that Freddie will be talking about and the kinds of impacts that will have on companies. Right? And so here we need to understand on the next image that for many companies, it's not something that's peripheral to us. It's going to the foundation of our businesses, of what we do as companies. We can't just think, well, we've got a really beautiful house here, right? If there's a risk, it might cost us a few thousand euros in some damage to the roof, or a little bit of driveway activity that we have to do, right? No, for many, it will be much more fundamental than that. For many, it might affect the size of the market there, and it might, to the point I made earlier, increase the raw material prices far past the margins that the companies have. It might change consumer preferences to a degree that will really affect the viability of our business, right? We talked about a lot of private equity organizations. For many of those, right, when they look 3-4 years in the future to doing an exit of the kind of investments they've made in different companies, then it may simply be that at that point, climate risk is so far priced in that if they don't prepare and create more resilient businesses, that their business is unsellable at the point, right? We also see the first examples of that, right? We think about companies like Volkswagen. I'm German myself, right? And the EV industry. It's clear that, of course, there are many reasons for Volkswagen, why Volkswagen and the German car industry is where it is currently at. But it's clear that they failed to foresee the technology transition and the speed they would have needed to adjust their operations with to be able to meet that in terms of transforming the company, right? And then you might, of course, say, well, that is a technology change, right? But it's very much the type of climate transition risk and climate transition effect that we'll see in many more industries going forwards, right? And that's why it is integral to the business. The last point I like to make is that for many companies, there's a slight formatting issue here. For many companies, it is crucial to understand that this should very much affect the investments they're thinking of making and the discussions they have about return on investments timeframes. What we see many companies right now doing is, of course, in business as usual planning, right? Preparing for a future under the anyways, the assumptions that it'll keep going the way it's always gone, right? And so many companies we see prioritizing profits in the short term and not adequately doing the investments to actually build the type of resilience, right? And the key point is here, we can do many things in terms of, our factory footprint, our production footprint, our supply chains that actually reduce the resilience risk, right? We see some of our clients having the initial assumption that, well, if climate risk actually comes, it'll hit all of us anyway, so there's no need in preparing. But that's just not true. We can prepare as businesses. So what I think many businesses should think about, that, especially if they have, as many typically do, a 3-4 year kind of return on investment time frame, that many of these disruption events might come around the 6, 7, 8 year time mark, right? And they should put in the processes now in order to prepare for them. And for many, that will also mean that in the short term, there would be, as you see on the green line, if you follow that, a kind of a climate risk adjusted investment plan where you investments you need to do, and the kind of conversations the companies might need to have with different investors about how to actually do the types of investments that will prepare the companies for the future disruptions, if it's physical risks or transition risks, right? Because otherwise they risk the near future. Tilly will talk a lot more about the internal processes and how we think about how that should be integrated and how a company works then. But with this, I'll round off my session and hand over to Freddie on the Climate Risk 101.
Thank you, Sven. So now we've started to see how climate-related risks are impacting businesses, both on the physical and the transition side, but we're going to draw back a little bit and start speaking about some of the kind of underlying theory that underpins climate risk and scenario analysis. I don't want this to be a lecture, and I hope it's not. There's got to be a test at the end, but I think it's really important to understand some of these underlying nuances, because climate risk analysis does tend to be a bit more nuanced and complex than maybe some of the traditional business risk assessments that you may be familiar with. And I also think that we want to present here some of the language that we use when we're conducting scenario analysis, so that you can take that language forward and integrate it into business decisions and when you're having conversations internally, but it's also useful for interpreting results from the scenario analysis in the first place. So we're going to look at the two different climate-related risks, and which tend to sit in two different buckets. So the first is physical risk. So this is looking at how the climate is warming and what the physical impacts of that warming are on risks, which tend to be a bit easier to conceptualize. This is things like flooding, heat stress, droughts, wildfires, all things that we've seen probably in the news, and increasing year on year. We see records being broken each year. And so it's something that we're a bit more familiar with and it's easier to grasp. And as the planet warms, we tend to see that these physical risks increase in the higher warming scenarios. So if we look out to a greater than 3-degree world, we see a lot more physical risks than we would do if we limited the warming to a 1.5-degree world. And even though we're already kind of sitting just beneath that 1.5-degree world, and we're already experiencing quite a lot of physical impact already, if we can limit that warming to 1.5-degree world, we're still going to experience a slight increase in some of the severity and the frequency and unpredictability of climate risks with that small increase. And this tends to impact businesses in two key areas. The first is site or asset risks. So this might be literally your physical assets, your production facilities, offices, but also your employees. And the second is supply chain risk. So looking at how the production sites or extraction sites of your suppliers are impacted by the physical risks, but also how the logistics supply chains are also impacted, both in the upstream and in the downstream of the business. So now looking onto the second bucket, which is transition risks. This is also one of the risks that Sven touched upon earlier. And maybe this is the one that I think is underappreciated and is a slightly harder concept to grasp maybe than the physical risks. But essentially, transition risks occur from the tools and implementation that requires or is needed to bring about that 1.5-degree scenario in the first place. So typically we see these as market risks, policy risks, reputation risks, and technology risks. And here we see the kind of inverse of what we experience with the physical risks. So in a low carbon world, we see much higher transition risks than we do in a high carbon world, mainly because in order to actually bring about that 1.5-degree world in the first place, we need all these market shifts, the policies, the change in reputational perspective, and the increased new technologies to actually facilitate that 1.5-degree world in the first place. And typically, I think maybe the policy and the reputational risks are ones that we're already experiencing and maybe a bit more familiar. This is, I mean, we've already experienced this in a climate risk perspective when we're thinking about CSRD and TCFD and the IFRS S2 reporting, which is requiring increasing levels of transparency on your climate risk disclosures, which is demanding more and more internal resources and capital to produce those reports. But I think potentially the market and the technology risk are ones that get slightly underappreciated and underreported on and under-acknowledged. And that's exactly speaks to Sven's point earlier around the VW's issues where they didn't foresee the market and the technology risk, and they didn't adapt quick enough, and now are in a position where they're potentially struggling for survival. So now we're going to look at actually how you bring those two different risks and assess which ones are material to your business. And we do that through what's called a climate scenario analysis. So we abbreviate scenario analysis into CSA just to add to the long list of climate sustainability acronyms that already exist out in the world. But essentially, it's a tool for understanding how companies can identify the material risks and opportunities. So I think the opportunities aspect is one that also is kind of underappreciated and underspoken about, because typically the risk gets the most focus because it's the one that we're kind of scared of. But actually, there's a lot of opportunities that can be identified as part of scenario analysis as well. When we're conducting a scenario analysis, there's three key areas that we need to focus on. The first is on the warming pathways. So we want to test what's the most extreme warming scenario that we might experience and what's the lowest warming scenario we might experience, so that kind of 1.5-degree world, but also what's the current policy, so that we're getting that kind of full spectrum of the possible warming scenarios that we might experience. And so we can understand the kind of full breadth of risks that the company might be exposed to. And we also want to test these across the different time horizons. So as Sven already mentioned, typically businesses are kind of dealing with maybe a 1 to 3 time horizon or a 1 to 5 time horizon. But actually in climate scenario analysis, there's a bit more nuance there where we look actually often all the way out to 2100 to really understand the long-term trajectory of how risks are changing and how they're changing through time. And that's a critical aspect of scenario analysis. And then ultimately, we want to identify which of those risks are the most material. And to do that, we look at what the exposure of the risk is. So literally just how exposed the asset is or how exposed the business division is if we're talking about transition risk. And then also understanding the vulnerability. So how well can the company adapt and manage those risks in the first place to mitigate the worst of the impacts from there. And as a result, the kind of product of the two scores gives us that overall materiality rating that we can then take forward into kind of deeper analysis. So once we've kind of brought those three concepts together, this is what we get in terms of a kind of overall project approach. So obviously with the kind of first piece is defining the scope, the depth and the breadth of the assessment that we want to conduct. Do we want to look at criticality of particular assets? Do we want to focus on suppliers? Do we want to focus on our company's assets? And then we want to bring that through and start looking at those physical and those transition risks that we've mentioned already and testing those across the three different scenarios, the high carbon, the mid carbon, and the low carbon, to understand which of those risks are material under those three different scenarios. And then to establish the materiality, that's how we bring in the exposure and the vulnerability and bring in that kind of the factor of those together, which gives us that overall materiality score. And typically at this point, this is the kind of basic level of analysis you need to do to meet the kind of basic level of reporting requirements that things like CSRD and TCFD and IFRS S2 tend to ask for. But then if we want to start to push through into what does best practice look like, and also kind of some of the strategic benefits, then we need to start thinking about quantification. So just because now we've assigned a number to one of these risks, we now want to start, what's the financial impacts of those risks? So thinking about calculating value at stake, which then can help to give us a figure to inform mitigation adaptation decisions that we can take through to management processes. And this is the point that kind of gets you to best practice. And it does start to also help to inform some of the more strategic-based decision-making as well. But really, if you want to push through into that kind of long-term strategic value creation, which is obviously the focus of this webinar, is you need to start then integrating the outputs of those assessments into your strategy and into your ERM, and really maybe also focusing on a greater level of quantification. Perhaps you pick one risk under one scenario and you really deep dive into how that's going to impact the strategy that you've set out to achieve. And that's something that Tilly's going to touch upon as well in the coming slides. So I also want to think about how the different size of your organization may be able to absorb different levels of impact from climate hazards. So for a small organization, potentially you just have a national presence, maybe one specific production site in one location, a major hazard could be completely disastrous. You may see over 50% of your revenue or 50% of your assets lost, which maybe potentially puts you out of business or puts you in a very difficult financial position. If we look at a medium-sized organization, potentially you have regional presence, a major hazard could have a major impact on maybe one specific business division, but it doesn't ripple through the whole of the organization. But potentially, depending on the level of impact, it could also have quite substantial financial impacts for your organization. Then all the way out to a large-sized organization, maybe you have a global presence. A major hazard could have an impact on maybe a specific market area, but it doesn't completely throw the organization off its long-term objectives of the strategy that it set out. But really the key reason for conducting the scenario analysis in the first place is to understand just how big a proportion of that pie that you might lose or be exposed to with the various different scenarios and the various different climate-related hazards that we've spoken about. And then if we shift that away from kind of a specific organization perspective and look at financial institutions, for example, if you've got a situation where maybe a financial institution has a fund, and within that fund, maybe there's 200 medium-sized organizations, even if maybe 25% of those lose 1 or 2% of their revenue, this can start to have a compounding issue across your funds, and it's a good reason for understanding just how exposed those organizations are within the funds that the financial institution owns and controls. So now just zooming back out and looking at the kind of global perspective, thinking this is focusing specifically here on physical risks, but I think it's also really valuable to understand how risks vary across the globe. So typically what we see is flooding or kind of water-related risks tend to occur in the kind of higher and the lower latitudes. And we see more of a focus for heat stress and wildfires in this kind of mid latitudes or around the equator. And what this means for your organization is that maybe you have a global presence, and so you need to understand how different risks are impacting different areas of your business and different assets, which will also help to inform how you manage and mitigate those. So there's no kind of one size fits all. There's no kind of blanket approach. You really need to understand how specific assets are being affected by specific risks in different regions. And the same is also true for your supply chain. Potentially, maybe you're in that kind of medium or small size organization, you're operating in one specific region and you're understanding just how exposed that specific region is for your organization. But you also want to understand, okay, well, maybe my supply chain is actually very globally reaching, and I want to understand how that supply chain could be disrupted through the climate related risks that we're seeing here. So it's a real key aspect to look at, both zooming out and looking at that global scale as well. And then finally, I just want to touch upon some of the regulatory signals that we're seeing so far. So this is just demonstrating how much the global economy already has reporting regulation in place, or they've committed to bring it in the next kind of 1 to 3 years. And typically, the reporting is what's driving the requirement to conduct scenario analysis in the first place. But really, we want to focus on how we can move away from the compliance and through to that kind of strategic value creation. And that's what Tilly's going to speak about in this next section. So I'll pass over to her.
Thank you very much.
Thanks, Freddie. Sorry to interrupt, but just another reminder to we're getting some good questions in already. But of course, feel free also to think about other questions that we can cover in the Q&A session afterwards, and then we'll be happy to take them up. So just a reminder. Thanks to get started.
Thanks, Sven. Okay, so now we're going to get a little bit more practical, and we've already built the argument as to why climate risk is important for business and why it poses both an upside and a downside. And then Freddie took us through more of the theory and the science around how you start identifying your different risks and opportunities. So now we're getting into the title of the webinar, which is actually how you start leveraging and using that insight to get a competitive advantage. And to be transparent, you might not get necessarily a big advantage on all of your risks, but actually it might be a case of just remaining competitive in your market or in the different products and services you launch. And as we saw in the previous slide, more and more countries and more jurisdictions are mandating climate risk assessments, and banks are asking for them more and more. So a lot of companies will have to be doing these sorts of assessments. So that's why I want to spend the next section trying to convince and build the argument as to if you're doing these assessments anyway for compliance, instead of doing a light touch, low insight, compliance-driven assessment that won't derive much value, it's actually worth doing it properly and integrating it into your business to actually really reap those rewards and unlock that value. And I'll spend the next few slides explaining what that value is and exactly how you can tap into those different value pools. So here we have our climate risk integration framework, which does look a little bit like a fly swat to the side, but is essentially mapping the process as to how you go from building your business case through to integration and then unlocking that value. So Sven took us through that first point around why you have to build the business case and the different stats and figures and really building that fire as to trying to convince either your management or the decision makers that this is a topic that really does need your attention. Then step 2 and 3 is going into the section that Freddie covered, which is, okay, how do you actually start identifying these risks? What is the science that sits behind it? So you do your scenario analysis, and then you get your climate risk assessment, and that's the red line here. So at this point in the process, you will have a list of the most material climate risks and opportunities. Now, what do we do with them? Throughout that process, you already would have been engaging with different people across your organization to actually understand the breadth and the severity of some of these risks. For example, you might have spoken to people in your procurement function to understand the potential supply chain risks, or in your human rights function, or human resources function, sorry, to understand risks to employees. So people have already been engaged as part of the scoring, and now it's time to re-engage them and actually start talking with them and understanding, okay, if we did have to start mitigating these risks, what would that actually mean for your team, your role? Is it possible? How hard would it be? And this is to really build the knowledge internally of actually starting to understand the art of the possible when it comes to mitigating these risks and actually turning those risks into value-driving opportunities. Once we've done that stage, and apologies if there's background noise, our neighbours have decided to do some construction work right now. So if there is, I'm terribly sorry. I will try and speak loud and close. So once you've socialised the results in the different teams, you then go on to the integration point. If we could just hop back a slide, please. Thank you. Yes, so once you've socialized the results in the teams, it's then into the integration side of things. And here we've split it across different business functions, but climate risk really does touch each layer of the organization, both in a negative and a positive way. So you really do need to layer that integration and make sure it's touching all the relevant functions in the right way. And I'm going to start with the ERM. This is probably one of the biggest black boxes of most organizations. Lots of organizations manage their risks in different ways, to different levels of maturity, to different breadths and depths. And also being realistic, lots of companies have lots of risks they need to be managing, and climate risk currently probably doesn't feature on that top risk register. But the reason why it's really important to actually integrate it into your ERM is because it needs accountability and needs to be monitored and acted on. I wasn't in the room when Volkswagen was having these discussions around the rise of the EV or China being more competitive in that landscape. But I would bet some money on the fact that it probably didn't have enough ownership and enough of an anchor position in your ERM. And what that might have led to, and as we see has led to, is that it wasn't acted on fast enough. There wasn't thresholds put in, there wasn't accountability, it wasn't monitored effectively. So it means action wasn't taken because there's lots of other risks they have to be monitoring, but this one slipped under the radar or wasn't acted on with enough speed, and now they're in the position that they are in. And I see this a lot with lots of different companies with the ERM function. So you really do have to have a look at the risk you identify as part of your assessment and then think, okay, do we need a standalone risk to be managing and monitored in the climate space, or actually is it linked to existing risks? But really have a robust process that sits around it to make sure that you are covering and being aware of how this might impact your business if you don't take action. That leads me on nicely onto the next layer, which is strategy. And integrating climate risk here is also all about having that longer term thinking and scenario analysis. And sorry, could we keep on the next slide back? I will get to the next slide in a second. Thank you. Yes. So yes, this is about integrating into your strategy and having that longer term thinking. As Freddie mentioned, we look out into 2100 when it comes to scenario analysis. And obviously that is quite a long time horizon for the strategy team to be thinking about. But actually applying this lens and applying that different scenario thinking does mean that you will be aware of different market trends, different impacts, and future-proof your strategy into these different futures that we might be going into. I think this is going to be incredibly important to have that longer-term time horizon, especially when we look around the transition risks, especially around the technology risks. We've all seen AI suddenly, almost it seems, come out of nowhere, and the speed that it has been adopted into everyone's everyday life. I don't think most people could have predicted the speed at which that has taken over. And that is now going to really accelerate a lot of the climate tech, hopefully, and move things a lot more fast in that direction. So actually what risks we would have seen maybe manifesting in 10, 15 years time are probably actually going to be brought a lot forward. Hence the real need and the drive to actually bring that longer term thinking into your strategy planning processes. Financing, and this is one of my favorite areas to talk about. Now, banks aren't necessarily right now pricing in for all of their loans, for example, a climate factor like the ECB is starting to do, but we are seeing this happen more and more. And I've had actually 4 requests in the last month from private equity and different investor related companies who are actually asking how they can integrate climate risk into their due diligence processes. So how do they actually start identifying if a company is managing climate risk effectively and how that might affect valuation and potential growth of that company. So it's coming. And if you're looking to raise capital, if you're looking to raise a loan in the next 5 years, even, I can see this being a big factor of your ability to raise that capital. So actually mitigating those risks will help you grow in the future if you do it properly. Then we have products and services, and this is more on the opportunity side of things as well. And we've spoken a lot about Volkswagen and their slowness in terms of increasing their electric vehicle production. This example can be applied across any and all companies. Here is really where the opportunity lies when you look at potential products that can both facilitate the transition and also making sure that your products don't end up stranded because they are linked to a product that's going to be heavily regulated in 5 years' time. And so then you end up with a product you actually can't sell or a market that won't even exist if we stay on different scenario pathways. But I'll give you some examples about some companies that have managed to really harness this in a second. And the last one is procurement. And I won't spend too much time on this one because I do think it is the most talked about example when it comes to climate risks. It's the most tangible and the easiest one to relate to because it's also we're seeing these risks happen every day. We've seen lots of extreme weather events in the last few months even, which are disrupting global supply chains. There is a real opportunity, especially now when tariffs have come in and lots of global companies with global supply chains are having to reconfigure their supply chains to avoid tariffs. But climate risk still isn't part of that conversation. And actually, it really should be. We should be thinking, okay, how do we make sure we have long-term, robust supply chains that aren't going to be in the path of extreme weather? And actually, it's going to cost us X amount of money in loss of production or in having to reconfigure on the drop of a hat in a few years' time. So if you're have those conversations now, then I really encourage you to also think about it from a climate risk perspective and making sure you're protecting it from that perspective as well, not just the geopolitical shocks and moves. Next slide, please. Now, I'm not going to pretend that this is going to be an easy transition to make, and there are challenges associated with actually integrating this type of thinking into these different functions. And I'll highlight some of them now, and I'll also provide you with some solutions as well, because it's not nice to highlight problems and not solutions. So on the ERM side of things, I've worked quite a lot with different ERMs in different companies, and there is a bit of a culture clash when it comes to climate risk. Because climate risk is inherently science-based, and it's very theoretical, and the analysis, depending on who does it and how broad you want it to be, can be very detailed and very in-depth. And if you bring that to an ERM, which actually the way they manage their risks is much more light touch, much more stakeholder engagement based, then there can be a bit of a clash in terms of level of detail and having to match those two. Also, as we talked about a lot, the time horizons are just very different. Our long-term time horizons for scenario analysis are 2100. For risk management, it's usually 5, 7, maybe sometimes 10 years. So even just linking those two and trying to merge them can cause some friction, but something that really does need to be addressed to make sure it's managed effectively. It's a very similar discussion point when it comes to strategy as well. Time horizons are sometimes only on a 3-year basis, and we're asking you to look to 2100. So that can cause some debates and discussions, but a very important one to have. On the financing side, we're not necessarily feeling right now the effects of restrictive financing from climate risk, but we will. I'm very sure we will in the next 3 to 4 to 5 years. But again, trying to build that argument internally can sometimes be a challenge. And a big challenge here is data as well. We've definitely seen an increase in the quality of public data when it comes to data from the IPCC. And there have been some data providers which have been fairly good in this space. But that being said, there's also a lot of potentially incorrect and misleading data when it comes to climate risk, especially from the financing side when you're looking across a massive portfolio. So we also have to be aware of the level of quality there. On the product side of things, I think it would be remiss of me to not talk about also the friction between short-term profit maximization and then long-term climate resilience. There will probably be examples where you can launch a product that in the next 2 years, which will make you a lot more money versus a climate resilient product that might be more long-term resilient. But we have to make the business case for this now, because actually we're talking about business survival in the mid to long term, not just in the next 1 to 2 to 3 years. And the same argument goes for procurement. Obviously, the margins is a big discussion right now, especially as tariffs come in. And it is cheaper to manufacture products in certain countries, not actually in, for example, Europe, where we will be experiencing less physical climate risks. But again, we have to be looking more long term, and it's going to take a long time to try and make your supply chains more robust and move them away potentially from countries who are going to be experiencing extreme weather events, or at least investing in protecting those assets. But if that is in direct conflict with short-term profit maximization, then that's also quite a tricky discussion to have. So the solutions to these challenges, I'm going to be honest, there is no one silver bullet. And when I go through these challenges with my clients, it's a lot of different fixes and different ways of trying to get around these. But here are some of the key learnings that I've had from my project experience. Number one being capacity. This is a technical topic, and it is a whole new language for a lot of people, and also a whole new way of thinking for a lot of people. So teach your functions what climate risk is, and specifically what it means for their jobs and their roles. Again, physical risk or the impact on procurement is going to be very different to actually the impact on your product and services team. So really speak to them in their language and help translate the results into their context, because they can understand the risk, but also the opportunity, and it really helps build motivation and energy to try and start tackling some of these issues. Building the business case, which Sven has also mentioned before. Once you've identified these different risks and opportunities, obviously you will need time and budget and willingness from the organization to do something about it. And this is when I want to spend a little bit of time talking about quantification. And that is essentially the quantification of the risks and opportunities that have been identified. This is becoming an essential part of these assessments. And sadly, it is one of the most complex parts as well, because there is no standard way of modeling and trying to calculate the cost of inaction or the cost of action when it comes to a climate risk, and then mitigating that climate risk or launching a new climate resilient product. But it is an area that we are working more and more in, and it is an area that I think everyone's learning more and more about. So if you want to hear more, you can reach out. I can speak on this topic for about 8 hours, but in interest of time, I think the key message here is you will need to start quantifying these risks and opportunities if you actually do want to get that buy-in internally and get resources put behind these initiatives. That brings me to my final point, which is the availability of decision-ready data. And I've alluded to this throughout. Public data is getting a lot better, but internal data is tricky. So for example, you will need to start collecting and monitoring consumer preference data or potential costs of launching a new market, or switching out a material from non-fossil fuel based, what that will cost you. And that is hard data, A, to collect, and B, just to have in the organization. But actually, once you have this in place, once you know what data you need to collect, the decisions come a lot quicker. Now we'll talk through some examples, because it is nice to end on a positive note in terms of companies that are doing this well. So I've got 3 examples here. First one being AstraZeneca, and they identified a transition risk, both a market and a regulatory climate risk, associated with one of the repellents in their inhalers, which was very polluting. So they developed a new product using, it's called a near zero global warming potential. So basically a low emission repellent. And that essentially resulted in, obviously, the launch of a new product, so a product opportunity. They were mitigating a regulatory risk, so minimizing that potential downside associated to a regulatory risk. And they also were differentiating themselves against their peers with wider decarbonisation expectations. So there was also a reputational upside there as well, and ability to meet stakeholder requirements on decarbonisation. So there were some upsides associated with the risks they've identified. Next one is Dow, and they are a chemical and plastic manufacturer, and they identified a physical and transition risk associated with a dependency on fossil feedstock in their plastics. So they introduced a flexible feedstock integrating bio-based and circular inputs into their production. And obviously increases circularity, which increases efficiency, reduces their reliance on fossil fuels, which also reduces that potential downside risk and the risk of stranded asset exposure as well. And they captured demand for a new product and a new sustainable plastic, which again meets wider stakeholder expectations for decarbonisation. So tap into it to a new market space there and really unlock that upside. And then one of the classic Nordic favorites that we always use is IKEA, and they reshaped their global logistics based on physical risks that identified in their shipping routes. So they actually switched a lot of their routes to rail, and they nearshored a lot of their production as well. And that protects their logistics from disruptions and also meets decarbonisation expectations as well. Now, I'm not saying that climate risk was the only reason why they launched all of these initiatives, but it did make these existing initiatives much more favorable, and it did really build the fire as to why they need to be acting on these risks that were identified. So it's sort of 2 birds, 1 stone. I'm 2 minutes over my speaking slot, but now we have a Q&A. So I don't know if you pass over to Sven maybe to ask the question.
Yes, thanks so much. Lots of information. It's a complex topic, but thanks for creating the link to the value conversation. We have a really good amount of questions already. Feel free to answer other ones. We have about 30 minutes left. We might go over a little bit for those that might want to stay a little bit longer, but let's go through these and try to cover as much as possible. I think we'll start with some of the more regulatory, but try to bind that topic off pretty quickly to then go into some of the more practical and value questions, and then maybe end on some of the philosophical questions. I see there's a degrowth question here that'll be fun to cover at the end. I think there was the first question maybe to you both, with the CSRD being deregulated and potentially weaker mandatory disclosure requirements, how should companies continue to assess and quantify their risks? And how do you think they can keep doing that in a way that remains credible to investors, regulators, and society without actually just doing box ticking exercises all over again?
I can happily take that one. I think the key aspect here is that climate risk doesn't wait for regulation. The risks are happening regardless of how deep and the requirements are to produce the information for those specific regulations. So really, we always take the lens that we're doing this for the strategic benefits beyond the compliance. Everything that we do will meet compliance, but the way that we design our project approach is to always make sure that we're providing enough detail and granularity that you can take those outputs, whether that's directly integrating them into your business functions or providing that data to the external investors and stakeholders as well. So I think the approach that we take is one that is kind of resilient of deregulation or rolling back on commitments. And we always focus on that strategic side.
I think it is also important to note that there is I think a lot of fear and trepidation around this topic because people think that and it is complex and it is sometimes hard to do. But actually, the more you break into it and the more you learn about it, the more you can unpick about it. And the way I always talk about it is a science, but it's also an art. And there isn't necessarily a right or wrong answer. It's very particular to the organization. So whilst conducting a very in-depth assessment might sound very scary, it's actually also asking you questions that you probably already know about your business, but then overlaying climate science to it. So when it's broken down, it's not quite as large and terrifying as it can seem to the outside. But that's also why obviously CSRD was good because it was really mandating companies to think about these. But actually, I think to Freddie's point, really start seeing it as a strategic tool and integrate it into those processes can also make it seem slightly more attainable.
Mm-hmm. Yeah, really good points. I'd also just like to add there, I think the sustainability field has done itself kind of a disfavor in the last years of just linking any kind of motivation for action back to regulatory compliance, right? And that sets a very low bar. Because as soon as regulation is kind of stopped, or is not active in a certain area, then of course there's a question: why should we keep going? And I think to Freddie's point, it's very much coming. It's already there. And as I also mentioned, we see many insurers and financial institutions moving on this. So it's just not an optional thing for companies to do. I see a heart there. Thank you. That's some good use of it. I would actually like to connect this to another question, because there was a question further down below on whether consumers are prepared to pay price premiums for products which are not net zero, and if there's any kind of immediate financial benefit. And I think because it relates very much to the same question, right? What is the short-term motivation to do this? And I think sometimes the field goes too quickly to these short-term, constraints about the discussions we're able to have with business, right? Because the typically companies work in a 2-3 year ROI, 4-5 year ROI horizon. But I think Tilly and Freddie have made the points before, and so have I. It's really the 5 to 15 year horizon that we need to be looking at here, and from that perspective to look at your investments and changes to the company. We haven't so far seen any evidence that there's a real price premium for more sustainable products. What we typically see, of course, there's some examples of that in very premium sectors, premium consumer goods for the wealthy segments of the consumer base that can actually afford it. But there's very little evidence. Otherwise, it seems to be more integrated as a kind of standard competition requirement in RFPs or B2B procurement processes. I think that might happen. That might be different in specific kind of commodity groups. Low carbon steel, low carbon cement. I'm pretty sure, given the size of the emissions, there will be some willingness to pay price premium. But I think that's not where we should keep our value or try to make the value case around. It's about the long-term risk mitigation and resilience building, where I think the case is much stronger.
I think if I was also to build on that, I would say that probably the act of not mitigating and managing also can lead to trickle-through effects to increasing prices, because when organizations then have to deal with a shock that they haven't prepared for, where do they find the capital? They probably look to next year's pricing and they bump up prices. So I think there's maybe a trade-off between both scenarios. Perhaps in a case where you're looking to mitigate and manage, maybe there is an initial uptick in your unit price, but perhaps in the long term you start to reap the benefits of that, and you can start driving down the individual unit price because you are resilient to dealing with those shocks and you don't have to pass them through to your customers. I think renewable energy is probably quite a classic example of that. Very low unit price, and is a benefit to consumers.
There's also like a B2B and a B2C distinction there, that the B2C consumers probably won't pay the premium, but actually B2B, if they have made commitments, they have got plans in place, they need to start meeting wider stakeholder expectations, there is more of a willingness to pay some sort of a premium. And also I think it's just, to Freddie's point, going to become a license to operate. If in even 3 years' time, then you look 5 years ahead, some of these risks are going to be very acute. And if it's very obvious that a company isn't managing them, then from a B2B perspective, you're probably not going to want to engage with them versus another company who has. So it might not even be a premium question. It's more of are we even going to do business with you question.
Good point. There's an additional question on the inclusion of other factors like biodiversity loss or acidification in our scenario planning and discussions, right? Can you cover how that is usually covered in the types of climate risks assessments we do? So where do we go beyond the simple CO2 impact question?
Yeah, I think in terms of the approach that we take now, I think you're right. It's very carbon focused, and there is definitely a need and a push to start thinking about biodiversity risk, which doesn't necessarily feature under the kind of the scenarios that or the underlying data sets that we use, like from the IPCC. And it's definitely something I think I'm open to admit. I think we're under reporting on, under focusing on, and there's definitely a stretch to need to think about planetary boundaries and how we can bring those into the assessment as well. So I think there's still a significant gap between taking into account biodiversity loss and the risks that are associated to that. But there is a growing area, the kind of TNFD regulation or the task force itself, I think is a really good framework for starting to assess those. And it's an area that I think needs more attention.
Yeah, and we see that more in so far more in specific biodiversity risks assessments that we also do. So less integrated, and of course we try to kind of cross-pollinate within of course the scope of the task that we have. There's an additional question of what do you do if you're a smaller company, right? Because I think a lot of the times climate risks are from especially smaller companies further down the value chain, less easy to control, less easy to have the kind of capital to potentially reshore, manufacturing or some of the supply chains. What do you guys think there? Maybe Tilly, do you want to start?
Yeah, I think it is a tricky one as a small company because they can be very large exercises to undertake. However, I do think as data becomes more available and as this topic is socialized more and more, they will become easier to actually to spot and probably do these assessments right sized to your organization. But I also think that's a key point to discuss is right sizing. If you are a small company with a smaller supply chain, naturally this assessment will be smaller because you're only looking at a few key spots. So it will be easier for you to do. But I actually think, especially if you're a small company that is growing, this is probably an incredibly important task for you to be doing and to be prioritizing because it is about robust, resilient growth. But I think there's a balancing act between, because you are smaller, it will be a smaller exercise, but it still is one you need to undertake versus if you're a large organization with unlimited resources, you probably also have a much more complex exercise to be doing. And I would lean on wherever you can on. There are lots of platforms and tools and lots of reading out there. And we can share some also after this that can really help start building you starting you off on that journey. But yeah, I think if you are a small growing company, this is one to prioritize.
Yeah, and I think in terms of the leverage, that is the difficult one, right? But that's also where then the question about kind of opportunities that arise from the transition, right? That you can make a better kind of forward-looking business case on are a really relevant question, especially for more smaller and agile companies.
Agile, actually, that's a very good point. I think that's a very key word to list here. If you are small and are growing, your ability to actually act on these risks and mitigate them are so much greater than a very large embedded company. So even more of a reason to start thinking about it now.
Yeah, that's of course also with the Volkswagen example that we've been keep hammering in on, right? There's of course also a big sluggishness effect that was part of why Volkswagen ended up where they ended up. But that's also why we see so many more private equity organizations now actually looking at climate risk in so much more depth because they have a greater possibility to still shape the organizations that they're working with. I think there was a good question on. I'm just trying to go through the list. Let's take this examples. There's of course the inherent kind of unpredictability and worsening of some of these climate effects, right? There was an example here given, especially climate risk in Spain, wildfires, heat waves, flash floods. They're becoming increasingly frequent and unpredictable. How can companies realistically integrate these evolving risks into their kind of business continuity planning, supply chain planning, investment decisions when there's so much volatility and traditional models fail to capture those?
Yeah, it's a really good point. And it's a difficult one to answer, I think, because typically what we experience, even though the data quality has really improved, it's not necessarily live data. There's a lag in the kind of baseline years, even though it's recently just had an update. We're still looking at kind of like quite historic changes across time horizons to inform what we think the future is going to look like. And so it doesn't necessarily take into account just how rapidly things have changed in the last 3-5 years. So it does make those areas that are very exposed to those kind of physical risks quite difficult to manage and mitigate. I think one thing perhaps that you can be sure, and even if they are becoming more unpredictable, is that trend is going to continue. And so the assessments, I guess, are kind of even more valid in those regions to really focus in on just where can we manage and mitigate, maybe not necessarily the severity of the risk, but the actual risk itself, because the unpredictability is I think, only going to increase, and then there's going to be a lag in the kind of modeling to enforce how you can make really informed decisions. But I think focusing on what can be done in the short term is probably really the key aspect there.
And that is of course also difficult if you're say smaller mid-sized company that has all your production in a certain area that is so where the unpredictability is rising to such a large degree, right? I do also think I want to harken it back though to the fact that we got to understand the reality of current climate risk understanding integration is just extremely low. And so a lot of times we're still at the point where we're discussing kind of the base things that companies should be doing to create more resilience, right? I was at a supply chain directors group a couple of weeks ago of many of the large companies in Europe, and it's clear that also now when they do tariff-induced decisions to rejig their supply chain, right? Climate risk is just not yet an integrated part of that decision making. And that's where I think there's almost a lot of kind of still it's complex, but low-hanging fruit that we're not really working with when thinking about reducing our or increasing our resilience. I understand we're already a minute over. Now I do want to take one of the questions around continuous growth and the and green capitalism, because it's always fun. Of course, there's no real answers to this, right? But there's two questions about economies are still built on assumption of continuous growth, and whether we see climate risk challenge that mindset. And then the question here, at least in the Danish media, of an article where scientists said that the green capitalism has failed. What is our take on this? Tilly, Freddie, do you want to weigh in on this complex debate?
What a question to end on. I think on the growth point, I do see a world if climate risk isn't taken seriously enough by lots of different companies, that actually we're going to see like a consolidation of different organizations, and it's probably going to be the larger ones who take the power. If obviously I don't hope this world doesn't exist, because I hope everyone really takes this topic seriously and does it properly. But if it isn't, I think you are going to see the large companies who actually act on these very quickly and probably become more competitive, and they grow, and we might see then a fallout of the small to mid-sized companies if this isn't worked with in the way that it should be. But that's why I think growth in the sense that stronger power to the larger ones and less to small to mid, or big growth of small to mid, and then the bigger ones who don't act on it quickly enough fall. But it is obviously, if we're working towards a 3-degree scenario world, business is going to be a nightmare. So we will have to not grow as fast, because we literally can't. There's going to be way too many physical hazards and big risks in that sense. But that's a bit doom and gloom, and I don't want to end on that. Anyone got any positive points?
Freddie, do you want to wager an answer?
I mean, I think I would echo what Tilly said. I think maybe, I guess, in the kind of the highest carbon scenarios, you could argue there's a kind of natural cap to growth and how much we can actually sustain societies underneath those intense environments. And so I think maybe the other aspect is that also climate risk doesn't necessarily evenly impact all regions. So you may see quite significant degrowth in particular areas, and you may see some form of sustained growth in other areas. I think there's always this kind of like tipping point with the argument around the transition to a different economic system, and at what point does that tipping point exist? Is it brought about through systematic change, or does it occur through a significant global shock? And I think maybe in the kind of outlooks that we're seeing in the scenario analysis, that you could argue that the climate risks that we're identifying and the scenarios that we're experiencing could lead us to an environment where you do see a significant one-off shock that does bring about a systematic change. Whether or not that's overnight, I wouldn't want to put my hat on it, but I think that's maybe the direction that it's going. I think it is highlighting some major limits to the economic models that we have. I think there's also a lot of underlying other issues that are not being addressed, and I think those are also I would think that climate risk amplifies those as well. And so there's got a lot of kind of tensions, I guess, between traditional economic issues and the overlaying of climate risk onto that. Whether or not we see degrowth from a systematic approach, or we see it from a climate collapse approach, I guess remains to be seen, and depends on how much I think people are willing to adapt and mitigate and manage the risk and move towards that low carbon world. That would be my views.
Good answer. I would agree with much of it. I would like to invite us, though, as a group, and this is not just because I'm a consultant that needs to believe in this theory to sell services. I would like to invite us to think about, especially when we talk about green capitalism, to be clear about what has been happening in the last 15 years and what could then happen in terms of kind of actual implementation activities in the next 15 years, right? Because what we've seen so far is largely slightly better governance methods, right? There is some hunt for some green premiums for products, right? We haven't tried wholesale sustainability integration into the business models yet, right? There is no carbon tax yet, right? So I get the point that green capitalism has failed. Yes, so far it's failed. But I think I can imagine many ways of how companies can innovate around this in a way that drastically reduces material footprint, that drastically reduces CO2 emissions, where we can do that under capitalist system. We just haven't, on the cultural side, gotten ourselves to the point yet where we value that sufficiently. So thumbs up, and let's all work for this going forward. Thanks everyone for the good questions. I think we covered most of them. We'll try to see if there's a few that we have missed that we'll still cover afterwards. Good day to everyone here, and good luck with your climate risk efforts. Thanks.
Thank you.
Thanks everyone.